traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly preview and review, so every other week of the market's key events and trading opportunities. Also, I'll just let you have a look at the disclaimers. There's just a couple to look at. I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal as well is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll be more than happy to answer them either as we go or at least after the webinar finishes. Okay, it's Wednesday, it's September 24, just after 11 a.m. in London. So let's just get to what we hope to get through in the next 30 minutes or so. We'll follow the normal format, so we'll just check out how markets are trading currently. We'll look at one of the themes which we have been looking at and I hope to explain. We'll then get into the main part of the webinar, which will be just reviewing really actually the big central bank meetings we had last week. Really important to review these and just check out what should happen, may happen going forward, of course. And we'll look at all the associated currencies with those. So we'll look at the DXY, the dollar index, the Bank of Canada meetings, the dollar CAD, Bank of England's the cable, sterling against the dollar, BOJ, of course, dollar against the yen. We'll then just have a quick preview of what's coming up this week, which includes the inflation data out of the US on Friday, and also, if we have time as well, we'll look at the quick look at the SMB, Swiss National Bank, and dollar Swiss as well. So here we are. First up is, well, how markets are trading currently. APAC stocks, they eventually traded mixed actually, following the subdued lead from Wall Street really, and Japanese markets returned from their holiday. Chinese markets were choppy before posting gains. Alibaba grew sharply after its AI release, I think it was. The DXY, that is higher and has picked up bids through the European session after the APAC session as well. Euro dollar actually briefly dipped under and is now trading below 118 after soft German business survey IFO data. The Aussie, that's been boosted by better than expected, stronger than expected Australian CPI data, and the yen moderately weaker after its PMI data. President Trump appeared and gave, he didn't see it, talked about a whole manner of things, but he potentially shifted in Ukraine. He's with the EU, addition all Ukraine back in its reform. Not really massive in beyond that. Bit of a shift, and we will come on those words. Otherwise, European equities, they're mildly milder really. Euro Stoxx 50 is down just around 0.1%. The cash market closed up 0.1% on Tuesday. I just want to get back into this theme really that we've mentioned, and and bonds, kind of asymmetric. So markets price in for the best of both worlds. Stocks, of course, highs, reflecting kind of an exception of a strong economy, but then bond yields and the dollar really have pretty much fallen. We've seen a sort of small pullback this week, obviously with this slightly more hawkish mixed message Fed last week, which we'll get into, but it all reflects expectations, of course, generally of near-term rate cuts, as if the economy is falling into a downturn. Both scenarios are, of course, unlikely to be right at the same time. And if you remember last year, the Fed cut rates and stopped when the unemployment rate stabilized, and that put a lot of upward pressure on rates and the dollar as expectations of cuts and a weak economy were then priced out. Stocks rose as the economy held strong, and that kind of benign economic outcome could repeat itself this year, but it's important to highlight it did not come without big moves in bonds and the dollar and basically the rest of the markets. Similar setup today kind of makes it tempting to hope history repeats itself, but as we just said, economic conditions are different today, and that means so is the Fed's reaction function. There's three sort of scenarios we think, if you can visualize those. So if unemployment rises, the Fed may deliver the cuts that bonds are pricing or more, but elevated inflation will make the trade-off harsher than last year, which means stocks are likely to be hit. If unemployment stabilizes, Fed then unlikely to cut as nearly as much as bonds discount, especially when considering the inflation pressure, which would be bad for bonds, while stocks could benefit from a resilient economy, just like last year. And we're kind of seeing a little bit of that now with bonds. Yields going higher, bonds going lower, with possible slightly more inflation worries on the horizon. There is also then the risk, the third sort of scenario, the risk that the Fed cuts even though unemployment is stable, and either misreading weak payroll growth or bowing to political pressure. That would be a kind of policy mistake, if you like, when, of course, the employment picture is shrinking really in the US, and that is obviously bringing then unemployment, that figure to stable to sort of low. That scenario would fuel growth and inflation and hurt bonds, but again, possibly keep a bid under stocks. The dollar then likely to rise, at least in the short term, in scenarios where the Fed holds back from cutting interest rates to the extreme that is priced into the market today. And that's what we've seen sort of over the last few days, that I've said, possibilities after these rate cuts that we may see or expected to see, and we'll get into this shortly, and that means that the dollar has been bid from those multi-year lows. So just thoughts on that and this sort of asymmetrical risk, as we said, and the potential going forward for what may happen. Moving on from that then to US equities, just briefly bring up a few charts here. Firstly, let's grab the S&P 500. Not a lot to say really about these charts, as of course they're going one way. Very nice upward ascending bull channel, really, series of higher highs, higher lows, and we just keep on going. Slightly overbought, as you can see on the daily RSI, so a little bit of a pullback, but just below those record highs. We did have the PMI report out of the US, which saw US equities struggle a little bit with that growth outlook. And then that was coupled with Fed Chair Powell's lack of clear guidance on whether he would support an October rate cut. Basically described the current stance as modestly restrictive, and that drove the VIX higher as well. And yesterday we saw a sort of textbook growth scare really in markets, equities lower, yields lower, and the VIX moving a touch higher. That's now just checking where that was actually. That's now above 16, has been below sort of 15 and 14 even. So yeah, just watch out for that. Dollar virtually unchanged yesterday. So yeah, US equities face a sort of challenging day. The S&P was down 0.6%, the Nasdaq down over 1% in the end. Chart wise, Nasdaq similar to the Nasdaq, sorry, is down 0.73%, similar to the S&P chart, of course, driven massively by a handful of mega cap tech names, around 10, accounting for around, I think, 35% now of the S&P 500, the broad benchmark index, that is, highest it's been in many, many years, that breadth or that narrow breadth, if you like. Dow as well, that's hit a record high, but then closed just below that record high at 46,714. Again, nice upward ascending bull channel. Okay, moving on from stocks then to well, the main events that we have just seen last week, all about these central banks, of course, those four major central banks. Let's first look at the Fed, of course. They cut rates as expected by 25 basis points to 4.25% after keeping that range stable at 4.25 to 4.5 since the start of the year. But we did get this sort of mixed messaging. Quite important to focus on this, really. If we start with the numbers, we got the updated quarterly summary of economic projections. And the US Central Bank raised its growth path over 25 and 20 to 27 policy horizon. Expectations around the unemployment rate shifted. And then we had both headline and core PCE deflators projecting 2.6 instead of 2.4. These are the numbers just around what we were heading into the Fed, if you like, and what we saw afterwards. But this summary of economic projections was important because ultimately, in short, we had stronger growth, lower unemployment, and higher inflation. And kind of without any additional context, that kind of would call really for raising the Fed funds rate instead of lowering it. And indeed, Fed Chair Powell labeled the rate cut as a risk management decision. And compared with the July policy statement and in line with the pivot made by Powell at Jackson Hole, the Fed now judges that downside risks to employment have risen. In light of that shift in balance from attention to both sides of the dual mandate, the committee almost unanimously decided to lower the Fed funds rate versus bigger dissent than was expected. That was a strong signal really from within the Fed that governors back Chair Powell, and they pushed back against any political attempts to manipulate the independence, of course, of the Fed. Only President Trump's recently installed Fed Governor Mirren voted in favor of a 50 basis point rate cut. So no Bauman, no Waller voting for that bigger cut. And that really was quite something, really, compared to expectations of possibly more dissent. Regarding the dot plots, of course, the median estimate for the end of year Fed funds rate now stands at 3.5 to 3.75, from 3.75 to 4% in June. And Powell stressed that this sort of median actually hides quite a wide split. And that split is basically 10 governors seeing at least 2 rate cuts this year, but 9 seeing, and that's out of 19, seeing a maximum of 1 rate cut this year. Of course, then we had Mirren, the extra person who voted for that 50 basis point rate cut. So interesting spread of views even, and quite widespread of that between the 1 cut minimum, 1 cut maximum and 2 cuts minimum, if you like. Going forward, it's probably telling that the press release didn't hint at a continuation of gradual rate cuts if things played out as expected. And that all suggests that we will be looking at data dependency, especially labor data, as key for markets going forward, and that we will be moving on a meeting by meeting approach more than we have done recently, if you like. That new risk assessment, as I've said as well, means that labour market data will carry a bigger weight than probably any upward inflation surprises. And yeah, interesting that markets kind of reacted in a dovish fashion after the median estimate for this year confirmed a scenario of 2 more 25 basis point rate cuts this year, but then it backed off that after Powell's more cautious stance in the press conference. Euro dollar, that hit a new year-to-date high, 119.19, but then returned back to the 118 area. Similarly with treasuries as well, reversing their initial move. main conclusion really then is that potentially we're likely for quite a volatile time into year end, really, as markets are trying to figure out if we do get more rate cuts or not, with sort of Powell slightly more hawkish, as we said, compared to some of those dots and some of the well, the summary of economic projections, which, as we said, and just to summarize again, stronger growth, lower unemployment, and higher inflation, even though the Fed are cutting rates. Here we just got the job employment numbers, and you can just see where unemployment is now compared to that high from 2021, not far away, 4.3 versus 4.5%, I think, pretty much. And then we've got the CPI data, still fairly sticky, above target, 2.9%, as we said here, and the core at 3.1 against obviously the Fed's target, that dotted line of 2%. Money markets, just for your guide, are still pretty much similar story. 44 basis points here priced in, so that is just under 2 more 25 basis point cuts. 2 meetings left in late October and then mid-December. So yeah, 25 basis point cut, and then 19 basis points priced in roughly, which is around a 76% chance of 2 25 basis point rate cuts for by the end of the year, really, from the Fed, and those are market predictions. If we just grab the dollar index chart, actually, which is here, you can just see a little bit today. Interesting. So we did dip down, as I said, on Friday, but then bounced back and finished in the green, sorry, on Wednesday after the Fed. That low, 96.21, a multi-year low, just taking out that previous July low at 96.37. I've shown you this before, but we've got a long-term trend line in there, which looks to be holding quite nicely from those 2011 lows and 2021 lows. If I just bring it to the weekly, you can just see that, and it's just holding prices quite well, that support long-term trend line. Always like to look at different time frames here, and also then just see the importance of some of these long-term lows, whether they are, and this then assumes even more strong support. At the moment, it has supported prices, so yeah, decent support here around this sort of level, 96.90 or so. Upside, well, capped potentially by the blue line, which is the 50-day moving average. That's at 98.02. Then you've got a long-term low and the first fib level of this move lower, which is around 99.51, and that low is from July 2023. Okay, that's the dollar index. Let's go to now just the Bank of Canada, and a chart which shows you unemployment rate rising quite rapidly, really, and above 7% now. And then you've had jobs added, employment change really now going negative. The Bank of Canada, they, as expected, actually cut their policy rate by 25 basis points to 2.5% last Wednesday. They see, and this is important really, see further weakness in the economy after growth contracted by about 1% in Q2, basically as exports and investment heavily weighed on growth. Employment recently declined again, mainly due to job losses in trade-sensitive sectors, and job growth also slowed in the rest of the economy as well. That is the key issue for the Bank of Canada, especially related to trade uncertainty, and that is potentially keeping the Bank of Canada to continue cutting rates into year end. The bank expects actually slow population growth and weakness in the labour market actually to weigh on household consumption in the months ahead. As I've said, CPI inflation, that was 1.9% in August, and the measures of core were near 3%, but the underlying inflation rate closer to 2.5%. It's really the combination then of weaker growth and less upside inflation risks which justified the rate cut there, and possibly ones going forward as well. Particular attention, of course, now to risks and uncertainties. And although they didn't give concrete guidance, markets do still discount a final rate cut, probably by in November is the next one priced, I think. There's the chart with that picture that we just mentioned. If I just get, if I just pull up a dollar CAD chart now, which has been struggling with the loonie, the weakest currency this month at least. Let's get dollar CAD, which is here, and you can just see, well, we did have in here actually a bearish sort of head and shoulders pattern. Didn't really play out, wasn't that convincing really, so we should get rid of that now. But we are in this upward channel really, which is probably a better technical pattern here. You can just see marginal upward bias really, and we bounced off the low part of that the channel really, and now we're up through the blue line, the 50-day moving average at 137.83. I think we've got two in here. Yeah. Just gonna picking that up. Yeah, so that's a 50-day, which we've held a couple of times actually, so that's good support, 137.83 around there. Then we've got this high from earlier in September, 138.92, before then this swing high late August at 139.24. But still in this mild upward channel. This black line is the 200-day moving average, which is at now just below 140. You can see there, top of the channel really. But CAD looking quite weak really, certainly against its peers, major peers, as I said, weakest currency on the month to date of the majors. Okay, moving on then to the Bank of England meeting. We had that last Thursday, of course. They kept rates on hold at 4% as expected. It was a 7-2 vote split. Interesting, 7 for hold, 2 for cut. Possible changes to that were called by some city economists. They maintained basically the MPC their guidance, which is again what we expected, of a gradual and careful approach to further withdrawal of monetary policy restraint. That remains appropriate. They did slow the pace of tightening, quantitative tightening of the pace of quantitative tightening to 70 billion pounds annually from 100 billion, again close to expectations. A November rate cut, well, that remains alive, around 7 basis points priced in, so around 27% now, I think, 26% chance of that happening. But the 22nd of October inflation report, that will be key to see if we get any progress with disinflation and downside risks to activity. At the moment, inflation is projected actually to go higher and hit near 4%, I think, over the next month or so, and that is then not good for the any hopes for rate cuts by the MPC. And it was really quite a cautious sort of statement, really, with worries still continuing, as I said, about this well, sticky inflation headache, as I've put here. That could then see November rate cut chances really diminish, even though, of course, that would be in line with the quarterly pace of cuts that we have seen, which are when we get the MPR, the monetary policy report, every quarter, which as said would be in November. If that October 22 CPI doesn't give us cooler prices really, then, and disinflation, then we would probably expect a delay to rate cuts. If we just pull up then cable. Just see a little dip, trading around the 50-day moving average, the blue line, 134.68 that is. We've got the swing high here, 137.26, and then that long-term high at 137.84. And then we've got a few lines of support really around here. at 133.86, and then going back to this swing high from September 2024 around 134.34. So interesting point here, whether we bounce off this. And certainly we will get more noise around the November autumn budget, of course, and fiscal worries about that potentially hitting gilts and then sterling as well. So much noise around that. One would probably expect some sort of leaking to come out about what will come out, either testing the water or potentially as proper policies, concrete policies, and then the market will digest that possibly before the event. So it will be an interesting few weeks building up to that for sure. Moving on to the Bank of Japan, that was last Friday, of course. We did have August CPI data as well out of Japan, which, well, the favorite metric used by the Bank of Japan, that's excluding fresh food, that eased from 3.1 to 2.7. That was due to utility subsidies. The core measure, that excludes energy, dropped only slightly to 3.3%, so both firmly above the Bank of Japan's 2% target. As expected, though, they did leave rates unchanged at 0.5%, but it was mildly hawkish, really, the meeting. We had a hawkish vote to 7-2, so notably 2 members voted for a 25 basis point rate hike. There wasn't an outlook report, so it was kind of a small meeting, so unchanged guidance. But the Bank of Japan also announced they will start to sell ETFs and real investment trusts. Those are J-REITs, sorry. It's kind of meeting 3 principles, including that it should avoid inducing destabilizing effects on financial markets. Yeah, interesting meeting, because with a solid growth picture and real wage growth back in positive territory now, conditions are lining up for an October rate hike. Decision then would also be supported by an updated growth and inflation outlook. A decent chance of a hike in the October meeting now. But we do, of course, the caveat to this is have that LDP leadership election. That's on the 4th of October. Now we have 2 candidates, Koizumi and Takaichi. Takaichi is the sort of fiscal and monetary policy dove, although I did see some headlines today actually that she pushed back against her dislike of rate hikes. But we will see what happens there going forward. Of course, in the build up to the 4th of October, leadership election, possibly postponing a rate hike to December, but otherwise many in the market thinking Bank of Japan go and hike next month. Interesting, after the Bank of Japan, the 2-year yield, Japanese yield, that jumped to the highest level since 2008, basically on expectations of a rate hike soon. The yen also strengthened to 148 before then moving lower, while the Nikkei actually dropped initially on that announcement of ETF selling, but then reversed that fairly soon. Dollar yen, you can see here then, we've got the black line, decent resistance, looks like. That's a 200-day moving average at 148.50. And then we've got the halfway point of this move lower, that's at 149.37. Below here, 50-day moving average at 147.67. And then this 38.2 retrace level at 147.13, tracking sideways still. Looked as though we were going to break down after the Fed meeting, but that reversed quite sharply, really, as Powell spoke, essentially. So we're back in this range. The longer we track in this range, and especially with this rejection of lower prices, then potentially we go higher. Got to break that 200-day, and then obviously we get up to sort of 149, mid 149s, with these highs just above, just below, sorry, 151 actually. So interesting point if we get above the black line, the 200-day moving average. Okay, let's now move on to Well, we also got, actually, just briefly, I didn't put this in, but we did get or have the PMI data yesterday. Important business activity gauge, really, this, as I've put here. And yes, just in the euro area, they came in largely as expected, actually. Positive surprise in services, offsetting weaker manufacturing data. Price pressures remain subdued, actually, with euro area prices easing slightly in September. And that kind of all just keeps the ECB on track to keep rates unchanged for quite some time. That's really reflected in market pricing as well. UK PMIs, just for your guide, they did come in weaker, actually, than expected. Composite fell to 51.0 from 53.5, and both services and manufacturing declined, with well, services still in expansionary territory, just about 51.9, but prices eased marginally. The employment index stayed weak, and the weaker data kind of potentially supports a BOE signal, although, as we've said, the September CPI data released in October 22nd, I think, should really be key in shaping the outlook for the Bank of England. Okay, this week's other main events then are, of course, US core PCE data, and then we do get Swiss National Bank. We also do have a lot of Fed speakers out. Have had some already this week. We had Mirren, predictably uber dovish, really, his belief that the Fed funds rate is in the mid 2% area. Remember, he is just a temporary appointment, so bear that in mind, of course. Flip side, though, we had Musalem, who said he sees limited room for further easing, and Hamack confirmed she's on the higher end of estimates of the neutral rate. Then, as I sort of touched upon, we did hear from Fed Chair Powell yesterday. He emphasized basically the Fed's need to balance inflation risks with slowing job growth, so not 100% focused on that, that jobs picture. He noted that current rates of 4 to 4.25% are high enough to curb price pressures. And then he reiterated the policy remains flexible, but cautions against both cutting rates too quickly and keeping them restrictive for too long. Interesting, really, slightly more hawkish tone relative to the FOMC consensus as expressed by the median dot plot, of course, for 2 more rate cuts this year. So that is something to watch out for going forward for sure. Just on the core PCE data then, Fed's favored inflation gauge expected to rise 0.2% month on month, 2.9% year on year. That's the core measure, remember. The Fed's median forecast for your guide, that saw the reading at 3% by the end of this year, but cooling to 2.6 next year from their prior 2.4 forecast. Will be interesting when we do get this, any pickup in any pickup in these price numbers, really, as a result of tariffs meant to be seen sort of from September to December, and we haven't had anything yet, of course, although the Fed or officials there are seeing it as a one-time price shift. So interesting whether we do get any uptake in the numbers from that. Okay, finally, yeah, let's look briefly, we've got a little bit of time, at the S&B. I'll just put dollar Swiss chart, so bear with me again. Dollar Swiss chart here, similar to the euro dollar chart in a way, of course. So dollar Swiss going lower means Swiss is strengthening. S&B meets, of course, tomorrow. They expect or expected no change to the benchmark rate. That's at 0%. Yeah, interesting, really, because officials have indicated the bar is quite high for a drop into negative territory. That's according to the S&B chairman, even in light, of course, of the headache caused by this strong Swiss franc. It's rallied around 15% against the dollar this year, set for probably that would be its largest annual gain since 2002. Gain against the euro, slightly more modest, very much more modest, up around 0.5%. For Swiss exporters then, like Nestle, if you think Novartis, Richemont, Currency strength kind of adds to the hefty US tariffs already. Swiss inflation has picked up recently, which could give the S&B a bit of wiggle room really to do nothing for now. Probably needs stronger evidence of cooler prices, although many analysts reckon we are now at the terminal rate in Switzerland. So dollar Swiss, you can just see really sort of decent long-term downtrend. We've got that multi-year low at 78.28 from just after the Fed. You've got the 50-day moving average just above 80.10 there. Just pull it back, actually see where that multi-year low goes back to actually 2011, that multi-year low. So interesting there. Looks like bearish consolidation before we move lower, although just watch out for that. That's on the monthly, of course. Quite a potentially a bullish sort of inverted candle kind of that kind of thing, pin bar really. Whether we can push up higher or whether it just means we're getting more prices and it was just first sort of go at moving lower. That move on Tuesday last week was a pretty decent breakdown. So yeah, just watch this because it is a multi-year low, so pretty strong support there really, potentially around this zone. An upside, as I say, capped initially possibly by the 50-day moving average at 80.10. Okay, we will wrap it up there. Thank you so much for being on the call. Really do appreciate you sitting in, listening in, and we will be back to you in a few weeks' time. Take care.